Well, welcome to the bond market update from Principal Wealth Partners. I'm Julina Ogilvie, partner and wealth advisor here, joined by Bob Paolucci, our founder and CEO. And we have a special guest today, Gibson Smith, who is founder of Smith Capital Investors. Gentlemen, welcome.
Thank you, Julina.
Gibson, I want to more formally introduce you, so let me just spend a couple moments there if I can. Gibson has 30 years of investment experience. He was previously the CIO of fixed income at Janus Capital Management. In his tenure there, he was a Morningstar five-star manager for both the Janus Flexible Bond Fund and the Janus Balanced Fund, which invests both in stocks and bonds. He is apparently fluent in Japanese from his days of Morgan Stanley and being in Tokyo. And I also understand, Gibson, on a personal level, I was told you love your family, investing, Colorado, and CU football.
Yeah.
So welcome.
Thank you. All true. The fluent in Japanese, though, I think we have to challenge that. I think I speak to about a fifth grader or a third grader's competency in Japanese. So, but love the country, love building a business there. Very passionate about Japan as part of my life. So it's wonderful to be with you all this morning.
Yeah, we appreciate your time. So let me first lay the backdrop, if I may, and where we currently are in this environment. So we are, inflation has fallen about 65% since last summer. The Fed is at the cusp of interest rate cuts. We have $6 trillion of liquidity, which is a record level. We have a liquid capital markets. We are in a bull market. We are in an election year. And we are recording this in the middle of a solar eclipse. So with all that said, if you could maybe kick us off with your assessment of the current investment environment.
Well, it's really been an interesting couple of years. And if we think about the last 12 months in particular, there's been this focus, almost obsession with the Fed ending its tightening campaign and ultimately reversing course and moving into an easing campaign after taking rates from near zero up towards 5.5%. And that makes logical sense when we think about Fed cycles and monetary policy cycles, that the Fed will do what it has to do to quell the concerns around inflation. And then once it's reached a higher rate that usually slows growth and does take care of recession concerns, they're in a position to turn or move rates in the other direction. This is part of the active monetary policy process that the Fed has engaged in for decades. It's very normal, it's very logical, it's part of the system. And other central banks around the globe follow a similar policy position or stance, in that they are actively managing short-term interest rates to influence markets and influence the direction of growth and inflation. So what we've been through, though, is been very extreme, particularly in the last 5 years. When we think about normal cycles that generally go 5 to 10 years, we've worked through two fairly major cycles here in the last 5, 6 years, with obviously the events of COVID being the extreme outcomes that were produced in the markets that forced the Fed into that zero interest rate policy. So at this stage of the cycle, we have, short rates very high. We still have a very inverted yield curve, but I think to many investors' surprise, we have equities at near all-time highs. We have credit spreads at near all-time tights. We have mortgage spreads at near all-time tights, and we're in a market with a massive amount of liquidity still flowing through the system and trying to find opportunity for return. For bond market investors, it's been 2 years of difficulty in terms of negative returns coming off of the zero interest rate policy. And we're finally in a period of time where interest rates look attractive, returns in the bond market look quite attractive, but it's really about actively managing some of the risk. There are definitely areas of concern, and there are definitely areas of opportunity. But to close out, when we look at monetary policy, we think about fiscal policy, we are at transition points in the marketplace. Fed obviously more biased towards easing and moving into a period of time where they lower rates, and fiscal policy, which has been very aggressive for the last 18 to 24 months, probably hitting barriers of its ability to continue at this rate. We all know we've been running massive deficits. Those deficits need to be financed, and they will have an impact not just on growth, but also on the bond market. But I'll stop there because we're headed down a kind of a long path, and I'm sure there are other questions associated with what I just said.
Yeah, that's great. Gibson, so you have a Fed that continues to repeat their data dependence, and at the same time, you hear them talking about the long and variable lags in the data. Um, can you be that data dependent when the data has a long variable lag? And or do you think these are just talking points to get them to the action point, which may come this summer?
Yeah, I think the Fed is in a very precarious spot for a myriad of reasons, a couple that I'll touch on. And I think we have to take the Fed at their word in terms of what they're saying, but we also have to be a little bit skeptical that they don't necessarily know where this is going to play out. They don't necessarily know where this is going. I mean, if we think about a couple data points, really one of the first major global pandemics in modern monetary policy period of time. I mean, there's obviously been pandemics in the past, but this is in a largely developed world and economies that are much bigger than they've ever been. So this shock to the system is really one that we've spent a lot of time looking for historical analogs to match up and understand what will play out. And the truth is, there's not really any good ones. So the Fed is forced into a position of trying to manage through this with the policy tools it has at its disposal, in many ways, hoping that what it's doing is setting kind of the path or buying some time towards what I would call more normalcy. So the Fed is data dependent, but we have to recognize they're data dependent in a world that they may not completely understand. And they're kind of learning, as we all are, as we walk through this. Now, a testament to that, which I think is really important, is the construct of this new modern monetary theory or modern theory around central bank activity, where the Fed has brought into play its balance sheet. It's created this somewhat fictitious balance sheet that it can buy securities in the open market, remove them from the market, and manipulate long term interest rates, as well as what it has done historically in manipulating front interest rates or short term interest rates. So the Fed, again, this is a bit of a policy experiment, and thus them being data dependent is really kind of the truth. But I don't think they know, as well as none of us truly know how this is going to play out. Fortunately, things are on the mend. The economy is doing well. Policy position seems to be normalizing, and ultimately, we'll still have a lot of questions. But I think as time passes, things will return to the normal state of monetary and fiscal policy, and markets will start to reflect more of, call it, market clearing levels than necessarily levels that have been manipulated by the government and or the Federal Reserve.
Time will tell.
Yeah, absolutely. In their most recent meeting, they hinted at potentially changing their quantitative tightening program, with not much more information other than saying we're considering altering plans. Could you provide your 2 cents on that?
Yeah, the Fed has been fighting inflation expectations. We all know that inflation has moved higher as part of the supply and demand disruptions that we experienced during COVID. As some of those supply chains have healed and we've seen the flow of capital and the flow of goods improve in the global economy, those inflation levels have come down. But as part of that process, we also saw wages moving higher. So wages were adjusting to the higher prices in the economy. And thus, the Fed being concerned that those adjustments up in wages are stickier than necessarily the adjustments down in prices. So the Fed worries that they've set the stage, or the Fed and the government set the stage for stickier, higher for longer inflation. So thus, they've had to be really careful in how quickly they want to change policy or how they want to move their position. Um, the way that I'm thinking about it is that this very strong and aggressive reactive mechanism at the Fed in dealing with the higher prices we're seeing in the economy will have to adjust lower. When you have a positive real rate of 2 to 2.5% on short interest rates, it leads to that policy lag time that you were just discussing. It has an impact when you think about the marginal consumption in the economy that is largely fueled by short-term borrowing. That short-term borrowing rate is very high, so it becomes a very high hurdle rate. And the Fed recognizes that the higher that rate is, it will all of a sudden start to crimp some of the marginal consumption, ultimately leading to lower growth. So the Fed is going to be on the move. The Fed is likely going to lower rates. I do think, though, going back to the data dependency, they need to see that inflation is contained and under control before they can be aggressive in lowering rates.
And Gibson, in at the start of this conversation, I referenced the 6 trillion that is on the sidelines. We also have availability of private credit to businesses. Does this alter the normal business and credit cycle? How do you see that play out?
Yeah, it does. And the Fed works closely with the large commercial banks and regional banks in managing the interest rate that influences the borrowing activity. And what we've seen really in the last 5 years, started about 10 years ago, but really accelerated in the last 5 years, is the growth in the private credit market, which is private institutions making loans to individuals and or companies or small businesses to basically fill a gap in the system to where certain banks had stepped away from making those loans, and they're able to make them at advantageous rates. What I think many of the private equity firms and the private credit firms realized as they started to see this business grow, and then we went into the COVID period of time where banks, in many cases, started restricting their lending, that the opportunities were even greater. And they expanded their lending away from just companies and into real estate firms and other areas of the marketplace to help them generate returns for their investors. And so it filled this gap in the market that was needed. I think it's worked out very effectively. But I always remind investors also, credit is credit. Whether you're a private institution making a loan, or you're a commercial bank, or a real estate bank, or a credit card company, markets go through credit cycles. And if you're in a cycle where the economy is slowing and people are having a tough time paying off their debts, you'll invariably have a rising default rate. And when you have a rising default rate, you then go through a process of restructuring and having losses on those loans. So credit is credit. Nobody has the special sauce or the secret ingredient to making credit completely resilient. It's lending and kind of going through a credit cycle. And I think there will be, as I say all the time, there will be some great returns, and there will also be a lot of tears generated as we move through the cycles.
Yes, absolutely. Looking at high yield bonds, for many of the clients listening, you can refer to them as junk bonds, the high yield sector. There's a lot of talk about how high quality today's high yield bonds are. That has to do with lots of liquidity, again, lots of refinancing back when rates were significantly lower. But there's been a lot of press about this higher quality high yield. Can you chime in on that, Gibson?
Yeah, the high yield market, and also the leverage loan market, which is just an extension of high yield, has really gone through an evolutionary process. And in the late 70s and early 80s, when the high yield market really started to emerge, it was a market where borrowers went to that couldn't get traditional loans from the commercial banks. The banks didn't want to house their loans on their balance sheet because they knew the probability of default was higher than the loans they were making to large predominantly industrial companies. And thus they felt like that market really wasn't attractive to them. So the advent of the high yield market came about in that period of time, and you saw a surge of companies moving to that market to take advantage of the ability to borrow at more advantageous rates because of the kind of public nature of that market. And it worked great for many, many years. We obviously gone through periods of massive correction and default cycles and so on and so forth. But what's happened here with these other alternatives for borrowing for companies is that companies are going to migrate to where their cheapest cost of debt is. And Sometimes that may be in the high yield market, it may be in the private market, it may be, inter-institution lending that helps them out, and other areas. And what it's resulted in is, in many cases, a kind of increase in the quality of the high yield market, or those wanting to come into the public high yield market. And thus, the high yield market's very different today than it was 20 years ago, and even different than just 10 years ago. When we look at the leverage ratios within the high yield market, they're the lowest they've been for 30 years. In many cases, the leverage factor between high yield and investment grade is only a one turn or two turn differential. So the market's very high quality today. Now, that doesn't mean high quality doesn't come with its risks. It still has risk. And with that risk will, again, be some wonderful opportunities, but also some tears in time. But the market is different today than it was even just 10 years ago.
Yeah. In Gibson, you're a core plus bond manager. You're multi-asset. You can sort of go anywhere in the capital markets. With that, what are you looking at right now? Where is the opportunity, and where do you see the major risks?
Let's start on the risk side, because I think that's really most important. We spend a lot of our time focusing on where the biggest drawdown or potential loss risks are in the marketplace, and do what we can to avoid them through an actively managed and security selection process. When I look out on the horizon today with spreads fairly tight and yields high, and equity markets at all-time highs, I think we're in a market where there is vulnerability to headline risk or vulnerability to shocks. And so we have tended in the portfolio over the last 6 months to be a little more biased towards defensiveness, really biased towards having a lot of liquidity in the portfolio. And when I look out around the world, or kind of on the horizon of the risks that we see, there are so many things that can go wrong. There are, in my opinion, more things that can go wrong than right. If we think about the elections, we think about the Russia-Ukraine situation, we think about the Middle East, we think about the continuous threat of China and what their motivations are, particularly as it relates to Taiwan. I think about energy policy, all this geopolitical risk and all these other risks. When valuations feel a little stretched or priced, almost for perfection, it's probably a good time to be a little more defensive and make sure you have liquidity to take advantage of new opportunities as they present themselves. So that's how we're positioned today. I get asked all the time, what's the risk that's keeping you up the most at night? And I don't have a great answer for the question today, because it feels like there are so many, but I do think we're going into a really interesting period over the next 6 months with the specifically domestic elections. We've got elections all over the globe where we could see a significant change in the current administration that could lead to some changes in policy. And then we also have the Olympics coming up this summer. And I don't want to, kind of create any doom or gloom, but anytime you bring countries together, there is always that risk of geopolitical kind of outcomes that could be harmful. So we're erring on the side of caution right now, being a little careful and watching markets very closely. But I will tell you this, Bob, in the last 3 years, this is probably the most excited I've been about the return potential of the fixed income market. I just want to be a little mindful that rates could move a little marginally higher here, and want to be in a position to take advantage of that for our investors.
Yeah, makes sense.
And Gibson, it sounds like from what we're describing in the environment, this is a great opportunity for you as an active manager that can go anywhere within the bond space. Are there opportunities that you see right now outside of an investor just going out and buying, let's say, the Barclays Ag?
Yeah, for sure. And interestingly, with the Barclays Ag, and this is biased with me as an active manager, when we look at the index that we're measured against, there are a myriad of risks inside of that index that we view as not investable. I mean, not the appropriate risk reward profile for even just a generic fixed income investor. So part of our job as active managers is not just finding opportunities, but it's avoiding other things in the marketplace that could bring harm or put people in harm's way. And we see a lot of that in the ag, particularly at current valuations. But our focus is first and foremost looking for companies and the securities of those companies that are going through a deleveraging cycle. So we want to own companies that have taken on debt for some reason. They may have invested in their plants, or they may have done a deal where they bought another company, or they may have taken on leverage for some other reason where they've gotten to the kind of the peak of their total debt within their company. And they see a process of generating free cash flow and using that free cash flow to pay down debt. And what we're always looking for, and this tends to be the best investments that we make, is that when a company is delevering or paying down its debt, it's actually accruing to the equity holder. So the equity is going up as the company is paying down debt. And those tend to be the best risk adjusted return and total return opportunities, which in the fixed income space. And the wonderful thing about them is they're always available in bull markets and bear markets. Companies make decisions, they make mistakes, they redirect, they change the overall strategy for the company or how they're thinking about their balance sheet. And that puts us in a position to go out and seek out these opportunities and take advantage of them in the portfolios that we manage.
That's great. Well, it's time to talk about it. You mentioned it. It's an election year globally. Is it altering your strategy? Do you get phased in the short term by these potential changes for policy, or Gibson, is that something that you do when it happens?
Yeah, I think you have to prepare for it. It's with any risk-taking exercise, the more prep work you can go into that decision point, likely you're going to make a better decision, or you're going to be better informed in making those decisions. So we look at the political landscape very, very closely, because you can see periods where administration changes or policy changes can have a huge impact on markets. I mean, particularly in the environment where we've been in, the influence of fiscal policy on markets has been extreme. Now, unfortunately, and I say this as not only a fixed income manager, but as a person who's concerned about the health of our country, we have two policies that have no regard for deficits, and both parties are very focused on spend and borrow. And we look at this as a kind of a universal policy between the Republicans and Democrats, not afraid of taking debt to a level above that of overall GDP, and not being very cautious about the interest expense that we're accruing, particularly in a higher rate environment. So I'm concerned that we've lost our fiscal discipline, and we've lost our focus on the real health of the United States as a country. And I've been worried about this for my 30 years in my career. I mean, when I joined in Wall Street in 1991, we were talking about debt being too big, and here we are at levels that are 5, 6 times that. And I think it's something we as Americans have to pay attention to. We have to kind of vote with a passion around what's in the best interest of the country. But as it relates to financial markets, there's a pressing point in front of us where the levels of debt create a confidence problem and or create an expense problem. And we can talk more about that if you'd like, but I think it's very important. The one positive I see coming, and I say this as a registered independent, is that whoever wins the presidency, we only have 4 years with them. We know that for sure. Right? There are term limits, and so we will have a new president in the next 4 years or 4.5 years. And I would encourage your investors to pay close attention, probably closer attention to what's happening in Congress than what's happening in the presidential campaign and election. There's a lot of seats at play. I mean, there's probably I don't know if it's a 10 or 15% probability that we end up with a Democratic controlled Congress and presidency, and probably around the same, percentage from a Republican standpoint. But when you have a unified Congress and a president, getting policy passed is a lot easier, and therefore can have much more influence on markets and the overall economy.
So Gibson, with that comment, if you were sitting on Capitol Hill and needed to create a proposal, what are the main items that are most important in solving where we are?
Well, and again, I'm going to stress I'm registered independent, so you can hold me fully accountable for these comments. I look at different stress points in Washington and different stress points as it relates to the economy. And we have been in a wonderful period of the last 2, if not 3 decades of peace and freedom of capital and freedom of trade. And those have resulted in kind of disinflation or deflation in the economy. They've allowed for really prosperous economic growth times, both here domestically and globally. And it's really pushed a lot of manufacturing into the areas where it's cheapest to manufacture the good and then export it into different countries. And again, that brings kind of an exporting of disinflation or deflation into the United States, which has been wonderful. Times of peace and times of free trade have created great opportunity. Post-COVID, I think we realized that the system had probably gone too far and had pushed maybe a little too far in terms of the real-time nature of the economy and didn't allow for much cushion for if something went wrong. And we're now in the process of self-correcting through that. And I think our dependence on China is a huge issue. And I think it's an issue that is largely misunderstood by markets and misunderstood by many. But if I was in Washington, I would continue to have that as top of the docket in terms of focuses on how we continue to diversify our kind of streams of supply chains into the United States away from China. I'd be very conscious of national security issues associated with that. And we're seeing some of this take place as it relates to the chip subsidizations and policies around that, which are very, very important and worth spending some time on. Secondarily, I would tackle the debt issue, and I would probably, really go to Congress and say we have to get back to balanced budgets. We have to stop this gamesmanship around hitting the debt ceiling and then a little poker playing between the two parties and then coming out with just raising the debt ceiling over and over. We've got to show some fiscal discipline. We've got to really focus on where we should be investing our taxpayers' dollars, where they are multipliers of economic growth and or in the best interest of the long-term health of the country. It would probably mean we would have to go after some entitlements and really focus on kind of how we're thinking about those tax revenues coming in versus where we're committing that capital. And then thirdly, and this is probably a little more controversial, but we have term limits for reasons. And when I look at Congress, I look at a lot of people who are lifetime politicians, and I don't know if that necessarily allows for, shall we say, freedom of change. And I think the current antics we've seen in Washington, particularly in Congress, with the changes in the speaker and other issues, are really a result of a real decay in the overall decorum of what's happening in Washington. I'd probably, if I were setting policy, really push my fellow Americans to kind of focus on term limits and really making sure we're bringing in a new group of free thinkers and the kind of looking at the best interest of the country. So those are three. Maybe they're not as controversial as I think they are, but those are the three areas that really cause me a little consternation, and maybe I lose a little sleep on those at night.
Great, thank you.
Yeah, thank you.
Gibson, we really appreciate your time, your valuable insight, and of course your performance, what you do for our firm and for our clients. So thank you very much for that.
That's
Can't
great.
thank you enough for having me. I'm flattered. I'm absolutely flattered to be with you.
That's wonderful. We appreciate it, Gibson, very much so.